Good day, my name is Dean Crocker. I'm an equity analyst with the PSG Wealth team, and today I'll be taking you through our latest EIA report completed on Anglo American. So on the 29th of July 2021, Anglo American released their first half results for the full year 21 period. The results reflected substantially higher earnings, really supported by stronger commodity prices across all the divisions, as well as sustained volumes that the various divisions were able to take to market. The group did see a nice improvement in terms of the diamond production, the diamond division, with De Beers reporting substantially higher results this period. The group then on the back of that reported substantially higher EBITDA levels as well, and you'll see in the following slides that of the EBITDA, about $7.9 billion was attributable to the high commodity prices. This allowed for stronger free cash flow generation, with the free cash flow improving from a negative $1.3 billion to a positive $5.4 billion. As such, they were able to increase the ordinary dividend by a substantial 511%. There was also a special dividend of 80 US cents declared, as well as share buybacks initiated also at 80 US cents. Further, the net debt was able to fall, or decreased by 73% to $2 billion. With regards to the valuation metrics, the substantially higher earnings did lead to an improvement in the valuations. It did make the company look slightly cheaper, and this did underpin our recommendation. To a large extent, the forward EV/EBITDA currently trades at a 21.5% discount relative to its 5-year average, as well as to its FactSet peers. If you were to utilize the 4.5 times EV/EBITDA valuation, you will see what our implied intrinsic value is in the latter slides. In terms of the company, they remain highly cash generative. The likes of the Anglo Platinums were able to improve their production and volumes to market, which we didn't see in the previous period. And this was also bolstered by the stronger iron ore prices, which benefited the iron ore division, particularly Kumba Iron Ore. They are fully divested from the coal market, particularly given that they've sold off their coal assets in South Africa. And then also the later this year John acquisition by BHP Billet of Glencore of their shareholding in that company. The group remains well diversified across various divisions, and they continuously trade at a low multiple right now, given the substantial improvement in earnings. On the back of that, the group remains financially sound. They have a strong balance sheet, nice diversification across a lot of different materials which are in high demand at the moment. It could be questionable as to the ongoing prices of some of those commodities, but as we currently stand, it does seem that the company looks fairly to offer some value off this base, whilst they remain financially strong, supported by strong free cash flow yields and a nice dividend yield as well. So in terms of the SA portfolio, we maintain or increase our rating from a neutral position to overweight, whilst in terms of the income growth portfolio, they do offer a nice attractive dividend yield. We do feel it is quite sustainable. The group is very strong and sound in terms of balance sheet, and as such, we've maintained our neutral recommendation. So looking just at the performance of the company and the results are released across all the various line items there, you can see there was a substantial improvement. Revenue was up by 114%, which bolstered also the stronger underlying EBITDA of 262%. It is worth noting that the costs did see a nice inflation. They were up by 15%, particularly given that there was a weakening in some of the currencies. Free cash flow turned positive from the negative 1.2, and then underlying earnings per share was the benefactor of all of the above, resulting in a substantial increase to 430 US cents per share. Dividends on the back of that were able to increase substantially as well, 271, as well as a special dividend share buyback initiated. With regards to the reaction by the market on data release, the market proceeded favourably, increasing the price by 4.37% relative to the JC cap, which was only 1.41% higher. Anglo's has, however, outperformed the benchmark on a year-to-date basis, and frankly, if you look at the table, they have been the better performer for the latter 5 years. With regards to total year-to-date return, that currently stands at 37.2%. And since our last recommendation in May, which was a neutral recommendation, the account has underperformed the benchmark by only 1.46%, so largely in line with the market. In terms of assessment, a lot of it was touched in the executive summary. The group really benefited from the ramp up in production and volumes of the PGMs, particularly Anglo Platinum, as well as then the diamond production. De Beers reports substantially higher earnings relative to the last period. That may have been due to some other events. But as it currently stands, there was substantial improvement in the group's operating performance due to those two companies. The group has fully divested from the coal operations, which will improve the ESG score. And it's very favourable that we've seen them paying out a substantial portion of the free cash flow in the form of dividends, both in the form of ordinary as well as special dividends in the share buyback as well. We do expect to see a pullback in iron ore prices. The results which currently reflect an iron ore price, a realised iron ore price for the group of $210 per tonne, where the iron ore price has already pulled back now in the latter stage of the past, call it a month or so, to a value of close to $170. So there definitely is going to be seen a reduction in the earnings of the iron ore business, which is Kumba. But it is worth noting that at $170, the group is still quite profitable. We do expect it to be quite challenging, however, for the group to grow or continue growing at substantially higher levels or such a high base. The thesis is, however, that if they're able to maintain the current earnings, we expect to see a strong full year 21 result, as well as the continuation of those nice dividends, which should bolster or allow for a margin of error in our core. We are, however, cautiously optimistic of the commodity prices. Investors should be cognizant that commodity prices do turn very quickly. They're extremely volatile in nature, and this has a direct impact on the group as well as its valuation. So it is just something that should be considered when investing in a mining company. However, we do feel that the company offers value at current levels, and as such have upgraded our recommendation from a neutral to an overweight position. Should you feel like you need to place an order, please speak to either the trading desk or your financial advisor. Please just take note of the disclaimer. Have a great day further.